Do not buy a stock just because of the hope. Do not buy a stock just because it has the possibility to go up. You must buy it because you know, based on what you see from the charts or the fundamentals, that it's an amazing stock to actually buy. You have to remember this, that cash is king. You have to remember this, that if you trade with an intention to earn from the volatility, you also need to learn that if the trade doesn't go your way, you need to cut your losses and you need to sell. It's a very, very important tool to protect you, because larger drops may take a long time before it would go back up. How can you plot and know if that area of support is something that's strong? You have to remember this though, when it comes to technical analysis, it's not just a science or a mathematical model on how you plot. No, it's also an art, in a sense that it also shows more about who you are as a person. It shows your risk tolerances, your time frame, your timeline, and the gains that you're willing to make. So what does that mean? The way I would draw it would be different from the way you would draw it, because you already have preconceived biases on how you plot your timelines as well, and the risk and the object of entry on where you want to come in and out of a stock. So how do you plot it? Just look at it from a concept of market psychology. What do I mean by this? Of course, a support is an area where there's a lot of buying that's happening. A support is an area where there's more buyers than sellers. So try to find a portion in the history of the chart that you are looking at, where as the stock started to drop down, it formed some sort of a support range. When a stock starts to go down, it forms some sort of area where the stock ceased to go down anymore. Why does it cease to go down? Because there are people who have started to buy the stock. You have to remember, when it comes to stock trading, more buyers bring the prices up. So it hits a level of support when the stock goes down, but because there's a level of buying there, buyers, investors prevent the stock from going down as well. So please remember this, buyers want to buy low, sellers want to sell high. So the fact that it does not fall anymore, it means that buyers are okay with that price already, and they're willing, and they believe that price is relatively cheap already. So when people think it's cheap, the stock or whatever market you're trying to analyze will fail to go down already. So look for that historical area, look for that area in the past portions of the chart where the stock fails to go down. Then look for another point, another area in the chart where the stock does not go down anymore. So what do I mean by this? One area plotted to another area where the stock does not go down, plot them together, connect those points together, and it will form a line. That line can be your support level. So how does this work? The more touches it has, when you start drawing a line, when the stock goes down, up, down, up, down, up, when it goes down and it touches a certain point, touches a certain line, and it fails to go down anymore, plot those two together, plot those lines together, and that will be your support. The more touches it has, the stronger the support is. The more touches it has historically, the greater the ability of that stock to actually bounce from it. And the longer the support line is, if that support line hasn't dropped that range for years already, the stronger and the larger the sense or the semblance that you have that it will actually bounce. So please remember this, the longer the time frame, the stronger the support is. The shorter the time frame, the weaker the support is. What does that mean as well? There's a bigger chance that it may break down if the support is weak. If the support is weaker, the time frame is weaker, but there's a bigger chance that it will just bounce if you have a longer time frame for that support range. So please remember this also, a support is not just a specific price point, it's a specific range. So it's not just, say, 10 pesos, it's probably 9.9, 9.8, 10, 10.1, 10.2, because it's a specific range. Those who use support and resistance in their trades are what you call people who do range trading. That's why it's not a specific price, but it's a specific range where you could possibly go through it and go through your trades as well. So I just really buy close to the support, and that's what I do over and over and over and over and over and over and over again. It may be moving averages, it may be Fibonacci, but all of those things are just based on support and resistance. So plot your supports well, look for areas where there's a strong support, look for areas where the market does not drop anymore, plot those lines together, and that's your support area. Now I'd like to answer the question, what are you supposed to do if you are losing in a stock, should you cut your losses? Or should you hold your positions? Or is it even wise to just consider even cutting your losses? You have to understand, especially for new investors, no, if a stock goes down and you do not sell, you are still at a paper loss. You don't actually lose anything yet. However, once you start selling, that's when you actualize the losses, and that's when you really lose money. And a lot of investors have been hesitating through the years. Now, should they actually sell? Should they actually actualize that loss and experience really losing real money? Because people keep having this notion that if I don't sell my stock, I just wait for it, it will actually go back up over the long term. Yes and no. Here's the thing: if you're an investor and you are buying an amazing company, if it goes down in price, for sure, good companies go back up. Good companies that are growing and have a durable competitive advantage will always go up. However, you don't know how long it will take before it goes up. You don't know if it may take years or even months before it goes up, and the opportunity for you to make money may be lost as well. So why am I saying this? If you are an investor and then you bought a bad company, meaning its earnings are declining, its company is so laden into debt, it had negative earnings, it's actually losing money, cut your losses right away. Rid yourself of the stress of holding on to a losing company. Try to find better use for your cash and transfer it into something that has a larger potential for you to make money anyways. So what's gonna happen if you buy a good company naman? If it's a good company and you're an investor, by all means, you can hold on to it. However, if the company is bad or it turns bad, please sell. Even if you're an investor, even if your timeline is long, please remember this: no matter how long you hold on to your stock, if it's still a bad company, if it's still in a losing position, it won't really generate good returns for you. It won't really give you a semblance that it could possibly go up, even no matter how long you hold on to it. Please remember this: a bad company will continue to go down until something changes or shifts in it. Now, if you're a trader, automatic, you need to cut loss. I repeat, if you're a trader, you need to cut loss. If you're at a losing position, you need to cut loss. If you're a position trader and the stock has reversed into a downtrend, you need to sell. You need to cut your losses, because you don't know how low it will go. You don't know if it will be the next Cemex. You don't know if it will be the next SSI. You don't know if it will be the next Del Monte. You don't know how low it can possibly go. Now, if you're a quick trader, same thing. The more you should actually sell. Why? If those support lines break, you need to sell. You need to get out of that position, and then you need to transfer your cash to a better stock that will give you a possibility for earning more. You have to remember this, that cash is king. You have to remember this, that if you trade with an intention to earn from the volatility, you also need to learn that if the trade doesn't go your way, you need to cut your losses and you need to sell. It's a very, very important tool to protect you, because larger drops may take a long time before it would go back up. And cutting your losses with a small amount of loss, that can easily be you can easily recoup that loss by just transferring your stock to a winning trade. You can easily recoup that loss because you get protected from holding a very, very long position with a very, very bad stock. So if you have any hesitation to cut losses, please study the stock very well before you come in. You need to know why you're buying the stock, and you need to set a condition also that will cause you to sell it. That's why it's very, very important to only expose yourself to an amount that you are that you can actually tolerate if it doesn't go your way. Meaning, if a stock goes down without blinking, you cut your losses. Meaning, if the trade is not in your favor, you cut your losses as well. We sometimes hesitate to cut our losses because the amount that we put, the amount that we expose ourselves in, is something that's above and beyond what we can tolerate. You have to remember, you cannot be in the stock market without having any losses. Losses in the stock market are also like battle scars that the more you get them in the past, it helps you build your own technique and experience to help you also, so you don't make the same mistakes over and over and over and over again. Sometime 2009, no, I had a friend, and context for those who read the books, I think I've shared this in Winning Strategies for Investing. 2009, the market dropped. Was just recovering from the drop of 2008 already, and you saw a lot of the stocks start to go up. And there was this friend of mine who said, "Marvin, you have to buy this stock, because this stock, I know the owners, I think this stock will go up, this stock will be pushed up, and you have to buy it." The stock went from 12 to around 15 pesos. Then from 15 pesos it went to around 25 pesos per share, which in context, no, in all intents and purposes, was really a really good movement already. A lot of the stocks from 2008, which were down, have started to move up already, but not that fast. So at that time, sabi ko, hindi, I don't like, I will not follow what you would tell me. I would still base my trades based on technicals and fundamentals. You have to remember, I already knew the technicals and fundamentals back then. But something happened. The stock went even higher. It went from 25 to 32 pesos per share. So as it went from 25 to 32 pesos per share, I saw my friend who made money from 12 to 32 pesos per share, and you know what he did pa? He did the exact opposite as what I would normally do. He would borrow money also to add to his positions. I would never tell people to borrow money just to add to their positions. It has to be cash that you have, cash that you are willing to lose should it go the other direction, should it go the other way. So when I saw my friend make 12 to 15 to 25 to 32, I got enticed and I started to go and follow his recommendation. He told me, Marvin, this stock from 32 will still go to 50 pesos. So even if you buy it now, it will still go to 50. You do not need to be scared because it will go to 50. I know the owners. I know the things that are happening here. So you know what I did? I actually bought the stock. And as I started to buy the stock went to 32 to 25. So I saw it as an opportunity because why? From 25 pesos, if it goes to 50 pesos per share, 25 to 50, it gives me a 100% gain. So I was blinded by the return. I was blinded by the potential of a stock going up. I was buying stock not because of technicals, not because of fundamentals, but just because my friend told me. I bought the stock just because of the hope that it will go up. Please remember this. Do not buy a stock just because of the hope. Do not buy a stock just because it has the possibility to go up. You must buy it because you know, based on what you see from the charts or the fundamentals, that it's an amazing stock to actually buy. So here's what happened. From 25, the stock dropped to 18 to 17 to 16 pesos per share. As it started to drop, you know what happened? I was panicking. As I started to panic, I went back to my friend, and you know what my friend told me? Marvin, add some more. Add to your position, average down. Why? Because if you buy from 16, 17, 18 pesos per share, when it goes to 25, you're not just break even anymore, but you make money from the move from 16 to 25 pesos. You make, and if it goes to 50, you make money from the move from 16 to 25 to 50. So now I was just buying just because I just wanted to, alam mo yun, yung feeling na you gusto mo makabawi because you made a mistake on your trade. That's what I was doing. I was buying not because I knew it was a good buy. I was buying because I just wanted to recoup my position, and I'm telling you that was a wrong thing to do. Never ever average down just because you bought at a high price and you want to buy it lower. You average down because you know the valuations are high and you know that the upside is big, and if you buy it at that position, it will give you a good leverage to make more and more money in the upside that you will get. So you know what happened after the stock dropped to 16. As it dropped to 16, it dropped to 15, and that's when I started to study. I only studied when I saw my stock started to go down. As my stock started to go down, sabi ko, now is the time to study, and that's wrong. And when I started to study, please remember this, 2009, I already knew what technical and fundamental analysis was. However, I did not study it, and that's the biggest mistakes that a lot of traders and investors do. They know already what they're supposed to do. However, in my experience, I did not study. Tinamad ako. I was so enticed by the greed of wanting to make it big already that I did not want to study it anymore. I thought that if I don't buy this now, baka maiwanan ako, baka the stock will go up without me. So I forgot. I did not do my technicals. I did not do my fundamentals. So with that, I lost money, and as I lost money, as the stock dropped, that's when I studied. So I don't know if this happened to you guys, that nag-start na lang kayo mag-aral nung naipit na kayo, but that's what happened to me. So if it happened to me, I hope that this is something, this sharing, especially if you are new, no, you don't have to go through the pains and mistakes that I did. Look at this. This is a very old and very traditional way for them to bring water, or I think water gets generated and it passes through this wheel. So why am I saying this? Look at this upward portion. It hits a certain portion where the wheel turns and scales back down, and as it goes down, it scales back up. You look at the market in that fashion. You look at the market in that way. When more sellers are present, when people just want to dispose the stock, you see it as a portion of the market that's over here, that it's scaling and going back down. But however, what drops hits a certain level where it becomes too cheap to ignore, and then suddenly the scales start to tip again and more people start to buy the stock and it goes back up. So think about it, think of the market as something that moves like that. So you become less emotional because you now have a conviction, you now have a foundation that there will come a point in time where the stock becomes relatively cheap, and as it becomes relatively cheap, it becomes too cheap to ignore, that people will just come in and buy it, and there will come a time also that it drops because people are just wanting to sell the stock. So that's it for now, with the entire goal and heart to help you reach your goals of financial freedom. I hope this video helps you trade well, trade strong, trade smart. God bless you all.